this class is being recorded for posted on YouTube. Today is Monday, October 3rd. This is the sign-in sheet. Passing around, make sure you sign in this before you leave today. And one announcement I want to make before we get into our class content. As you're aware, you're all going to be writing a lot of papers this semester. Every paper that you submit is put through something called Turnitin, okay? And Turnitin will give you a score, which you can actually see on your paper when you submit it. What Turnitin does is it checks against any other submission in its database, including the submissions for the current assignment, and basically gives a similarity score. So let's say your similarity score is 50%. That means 50% of the words in your paper are an exact match for 50% of the words in another paper in their database, including in this assignment. I consider that plagiarism. So any Turnitin score of 30% or higher will be sent to the Honor Council for suspected plagiarism. Okay, so I'm just letting you know it's not worth it. You're gonna get caught. I've already sent 2 students for these assignments to the Honor Council so far this semester. I would hope I wouldn't have to explain why this is a bad thing, okay? But the university takes plagiarism very seriously. And I'm just telling you, if you're writing a 500-word paper, like, it's not worth it to potentially risk an XF for the semester because you decided to copy somebody else's paper and basically use it as a template to turn in your assignment, okay? You're gonna get caught, and it's not worth getting caught. I hope I didn't have to explain this to everybody, but I'm just stating every assignment goes through Turnitin, and using somebody else's paper for your work is frowned upon. You shouldn't have to do it. You should be able to write original work for original assignments. So anyways, just want to make that clear to everybody. So the other thing we're going to do today is we're going to spend a little time going through the solution for homework 5. Okay? And the reason I want to do that is that it is kind of such a fundamental approach to the way that we are doing this class that I want to make sure everybody understands how to convert these statements and what they mean. Because starting Wednesday, we're going to get into analyzing these converted statements, which is going to be your next group project assignment on Dentsu. Okay, so just as you did your EIC on Dentsu, you're going to do the historical analysis on Dentsu, both analyzing their CFI and analyzing their ROICs through an ROIC tree. But in order to do that, I want to make sure you understand the statements that you are converting. Okay. Also, your midterm exam will be a conversion. Okay, that's going to be the upcoming midterm individually. So I'll give you statements, you'll have to convert them, you'll have 90 minutes to do it. And so very important, fundamental to the work we are doing this semester. So today we're just going to kind of go through homework 5 in class, make sure everybody understands it, the solution for it, create that, and then we will, as I said, Wednesday, we'll get into how to analyze these statements. Right? So that's what's upcoming this week. The other thing I want to do is a quick check-in on Bloomberg. I believe this is section 301. So let's see how we're doing. So as of today, good news is everybody's taking the minimum cash requirement seriously. So everybody is good with available cash under $300,000. Again, I don't count here. When you do finish the first half of the semester, you have to have at least 10 longs. Okay, so 3 of the 6 teams have hit 10 longs. The other teams are pretty close, but nonetheless, you do have to have 10 longs by the end of the first half of the trading competition. And this would be the ranking based on portfolio value as of today. So again, the market's been really tough. We see 2 teams that have a positive return and 1 team with a very big negative return. Good news for them is the first half of the semester resets after week 6, and you'll go back to $1 million. But there's still 3 weeks to go. All right, questions about the trading challenge? Just a quick check-in for everybody's benefit. All right, so let's talk about homework 5. So this was the statement you were given for homework 5, and we had to convert this into economic statements. As we talked about before, it didn't matter whether you started with the income statement or the balance sheet first. You had to do both statements. okay, before you did the CFI. And then you have to do the CFI and eventually the EP. All right. So I'm going to go ahead and start with the income statement first in our solution. There we go. And we'll label this the TII. Make it a little bit bigger so everybody can see. And then we'll start over by copying the years. So it's easy to do. As a matter of fact, on a future assignment and or midterm, I might give you more years, like let's say I give you 5 years or 10 years worth of data to convert. Shouldn't be scary, shouldn't take you any more time to do it as long as you're kind of following the process and copying and pasting. Okay, so 3 years should take no different time than 5 years. Okay, because again, as long as you're putting the right things in the right places, you should be okay. All right, so again, following Modigliani-Miller, we're going to put everything into an operating and then a non-operating and a debt and equity. Now, for homework 5 and the midterm, I'm giving you the labeling. Okay, 1, 2, 3, 4s. Remember, labeling is unique to this class. In the real world, you won't see labels. So when we get past the midterm, and we get into the third section of the class on valuation, and you get into real company statements like a Dentsu, like it's not going to be labeled. All right, so you're going to have to start getting familiar with the things that go into each of the categories. Because if you're valuing a company later this semester, and those statements don't balance, okay, then what you're going to have to do is you're going to have to figure out what doesn't balance about those statements and put it in the right place. Okay? And as I said, when you're dealing with a company statements, it may not be as obvious as these simple statements I'm giving you before the midterm. Okay? But nonetheless, as you're learning this new language, before the midterm, I will continue to give you the 1, 2, 3, 4s. Right? So back to this. First thing we want to do off the income statement, there's our hypothetical income statement, is take everything that's an operating item on this income statement and put it into the operating bucket of the TII. Also remember on the income statement that the income statement ends with net income. Okay? So when we convert this statement, dividends are not part of the income statement. So common and preferred dividends. I put them on there as convenience, meaning we will get them from the GAAP statement of cash flows. But if you try and put those onto the TII, your TII will never balance. Okay? So TII goes through net income because it's just the income statement which ends with net income. So that being said, I also said we could start with the shortcut. The shortcut was EBIT for all the operatings above, or operating profit. So we'll start with EBIT. And then we also talked about how we are going to spread out the taxes into each one of the sections. So if we had 310 million of EBIT, what would be the tax on the EBIT? So we would have the after-tax EBIT, which is called no plat. Okay? So again, I give you the tax rate on the assignment of 30%, but if I didn't give you the tax rate, you could have taken the taxes on the income divided by the income before tax to figure out the tax rate. Okay? So for example, let's say on the midterm, I don't give you a tax rate, you could still figure out what the tax rate is by looking at the income statement. Okay? So nonetheless, we know what the tax rate is, 30%. So what we'll do is we'll take our 310 million, and if that's all we had, we would pay 30% on that. So we pay 93 in taxes, which would get the 310 minus the 93, which would get us 217 of no plat. Okay? So if nothing else, this should be the easiest part of what you're doing for credit on any assignment is getting the no plat right. You may not get the TII right, but you should at least get the no plat right. So that was the no plat. And that's our operating profit from the income statement, again, tax affected. Right? Now, we're then going to look for our twos, any non-operating profits from our, or losses from our income statement. As we go back and look at this income statement, we see that there are 1, 2, interest income, and a second 2, non-operating income or loss. Okay, so we've got 2 2s on here. Just out of curiosity, why do you think interest income is non-operating? Why do you think interest income is non-operating? Yeah.
Because you're just earning interest on cash that's just sitting around, you're not doing anything with?
Yeah, and it has nothing to do with sales. And by the way, where on the balance sheet is interest income being generated from? What's the corresponding balance sheet item that's giving you the interest income?
Excess cash.
The excess cash. And we're calling excess cash non-operating on a balance sheet. All right. So again, prior to this class, I spent the last 18 months through August as the CFO for a $400 million subsidiary of the $21 billion insurance company, Blue Shield of California. Okay. So every month, I had to make sure we actually managed cash within our subsidiary. We had enough cash to pay our bills. Okay. So we had at any point in time $60, $70 million of cash lying around. And so what we did is we put some of that cash in Wells Fargo, and we earned interest income on it because we knew we weren't going to pay it during the month. And the cash that I needed to basically make payroll and pay the bills on a weekly basis or bi-weekly basis, that we didn't give to Wells Fargo to pay interest, that we left in essentially a checking account to pay bills as necessary. So I'm just saying, like companies, I told you this last class, like CFOs kind of know, I need this much to run the business day to day. The extra cash I don't need, I can go earn some interest income on because it's better than just sitting in an account earning nothing, right? And so again, same idea here. That excess cash that's earning the interest income, it's non-operating, but it still has value to the firm because it's cash that the bank is giving me for the cash lying on hand. So I do report that as part of my TII, okay? So back to my TII. So two things. One, I have interest income, as opposed to interest expense, by the way, which goes to a bank or a bondholder, and that's debt. Okay? This is another reason why you can't use Investopedia in this class, because the definitions that other people use don't apply here, because a lot of people will just do a net interest income. They'll net the interest income against the interest expense. All right? Technically, you can do that, but we don't do it in this class because one is non-operating and the other's debt. And you're going to start seeing why some of the shortcuts people use are truly shortcuts and may or may not be used. I'm not saying they're right or wrong, but I'm saying if you kind of go this Midigliani-Miller approach, you wouldn't do it that way. You wouldn't net the interest expense because one is non-operating, the other is a debt cash flow. So we actually break them into the right buckets. Okay? So I also want to just tell you, if you see another professor in another class that tells you to do net interest expense, I don't want you challenging them. Okay? It'll get you in trouble, right? Because you don't want you arguing with professors like, no, you shouldn't do it that way. But I'm just telling you, in the Midigliani-Miller approach, you'll theoretically understand if people are doing things differently or taking shortcuts going forward in this class, because you'll kind of understand conceptually what's actually happening. And that's not taught in a lot of other classes, right? Or in the textbooks that they use. It's just FYI. All right, so interest income. I'm going to put this 3 rows down. And then we have the other 2, which is non-operating income or loss. All right. Now here's the reason why I put this 3 rows down, because the next row for interest income, let's copy and paste these over. Slightly smaller, there we go, is if we reported 20 million of interest income, we would have to pay tax on the interest income, right? And again, at 30%, that would be 6 million. So that on an after-tax basis, the after-tax interest income would be the 20 minus the 6. Now, again, if you're a whiz kid and you know what's going on, you don't have to write interest income, tax on interest income, after-tax interest income on the statement. You could have just written after-tax interest income equals interest income times 1 minus tax rate and solve for 14 directly. But I like to write it out because when I'm learning a new language, it helps me keep track of what is actually happening here. Okay, same thing with non-operating income. All right, we're going to have the tax on the non-operating income. Income, and that's going to get us our after-tax non-operating income. So again, if we pay $24 million, we're going to pay 30% of that, or $7.2 million in taxes. So 24 minus 7.2 is 16.8 million of after-tax non-operating income. Copy and paste this over. So that is my 2. And so essentially, okay, paste these over. So my 2s. So that my non-operating profit, I'll use a slightly different word because I'm going to add these two together. My non-operating profit equals the 14 plus the 16.8, or 30.8 million of non-operating profit in 2017. Copy over the couple years. Now here's the other thing you could have done. You could have taken the 20 and the 24, added them together, and had 44 of pre-tax non-operating income, tax affected it to get to that number, right? As I said, if you're comfortable doing some of these things, you can go a little bit more advanced, but I'm just writing it out to break it out so you kind of know what's going on, right? But the whole idea is I have the operating income, no plat, after tax, and I have my non-operating income after tax, and I'm going to add them together, and that is going to get to me the total income available to investors, or TII, which is going to equal to the 217 plus the 30.8 in the year 2017, or 247.8 million. So that would be the income available to distribute to my investors from the income statement, TII. Questions about anything so far? Hopefully this is a fairly straightforward statement for many of you. All right. So again, now we go to the financing side of the statement. And the key point here, beyond it has to balance, is back to the signs. So again, this is not GAAP statement of cash flow. That will confuse you. Right? So this isn't about the change in the cash. This is about Modigliani Miller, which is I have cash and therefore I can pay it out. So the whole point is if this statement's going to balance, on the financing side, I need to have 247.8. You can't have an absolute value. It's not negative 247.8. It's actually 247.8. So the only way that's going to work is that if payments on the other side of the statement are positive numbers. The distributions are positive numbers. Because again, conceptually, I generate profit, therefore I can pay out the profit. The payouts are positive. I have losses, negative. That means I have to fund the losses, negative, on the other side of the statement. Okay? So on the TII and the CFI, just remember that when you get the funding flow, payouts are positive of anything, inflows are negative. Okay? And that's the way the statements are going to be structured. So when I go to my financing side of TII, my first one is going to be, look for my 3s, it is interest expense. That is my only 3. So again, that is my pre-tax interest expense. Now, following this methodology, this is minus 54. Okay? So that's the point. If I think this through, this is a distribution to the debt holders. I'm paying the debt holders $54 million worth of interest. Therefore, if payouts are positive, even though on the income statement is listed as a negative number, I have to flip the sign. Right? Now, in the midterm, I could give you interest expense as a positive number on your income statement and just subtract it to get to net income, okay? And then I wouldn't have to flip the sign. That's what I said. I wouldn't just kind of create this auto template that always works this way, because always never works, right? And that's why it's more helpful to think about what's happening with the cash flow here. What's happening with the cash flow is it's a distribution. Therefore, distribution is a positive number. Therefore, I have to flip the sign. That's the way you should be thinking about this more conceptually. Okay. Questions? All right, so that is interest expense, right? Now this is going to be tax affected, just like all of the other parts above. So I will then have my tax shield, spell shield correctly, on the interest expense, which is going to get me my after-tax interest expense. So again, if I pay 54 million, I take 54 times 30% of that. I'll save 16.2 in taxes. 54 minus 16.2 is 37.8. So that is my cash flow to after tax to my debt holders. Right? Now, final part of this is the shareholders, the fours. Okay. Now, again, I told you we stop with net income, but on the TII, there's two fours. There's a minority interest and there's a net income. So those are my two fours. Equals minority interest and net income. So first of all, what is minority interest and where does it come from? Does anybody know? What causes you to have minority interest on the income statement? What does it mean? I'll give you a hint. It comes from the minority interest in the balance sheet. There's a minority interest in your balance sheet and a minority interest in the income statement. How are they related? How does minority interest on a balance sheet show up? Did you guys take accounting? Did you cover this in accounting? Do you remember your accounting? This has been in your probably accounting 101 section. All right, so a little refresh. So if a company buys another company that it controls, okay, so I buy you, but I don't own 100% of the company, but I control it, so more than 50%, so I'm controlling interest. Under accounting rules, I consolidate the whole company as if I own it, okay? So I'll take all of the assets, even though I don't really own all the assets, but I'll take all the assets and add them to my statements, all of the income and add it to my statements, okay? However, I don't own all the assets, right? So the percentage of the assets that I don't own is called the minority interest on my statement, because I owe the shareholders for the assets that I've consolidated, their portion belongs to them. So on my balance sheet, I list that as a minority interest. So it's a liability to the other shareholders because they have a stake in some of my profits on the assets. So basically the assets that were part of that business that they own a minority stake in. So I owe them equity. So you could technically call this a liability or you could technically call it equity. The book calls it equity. Okay? But it's a minority stake because it's equity in the business that I control, that I consolidated, right? Well, here's the point. When I make profits on their profit for the assets that they own that I control, I have to give a portion of those profits to them, okay? So the portion of the profits, because I'm taking 100% of the profits, even though I'm not entitled to them, I owe them something for that. So the percentage of the profits that I owe them is the minority interest on the income statement. It's a distribution to those minority shareholders, okay? That distribution is basically a dividend, okay? So essentially what the minority interest on the income statement represents is a dividend to the minority shareholders, right? Because the tax authorities want me to pay the taxes, right? So the idea is the controlling company should pay the taxes, right? As opposed to chasing down a bunch of minority shareholders asking them where your taxes are. So I pay the taxes. Then after I pay the taxes, I give them a distribution, right, of what their share should be. So it is an after-tax distribution. So I don't double tax the minority interest because it's basically a dividend, okay? But that's the other thing. On the income statement, it's a dividend. Okay, so let's say that I made $100 million that belongs to the minority shareholder, but I only gave them 80. On the income statement, I'd have a minority interest distribution of 80, and the extra 20 would act like retained earnings, and the minority interest stake on the balance sheet would go up by $20 million. Okay, so on the income statement, two things: minority interest is already after tax, you don't want to double tax it, and number two, it's going to be a cash flow. Okay. Now, here's the other thing. If you're trying to understand as you go through these statements, what is something I need to tax effect and what is something I don't, generally as a rule, right where it says taxes on income, everything above that is probably pre-tax. Everything below that is probably after tax. Okay? I'm not saying that some accountant somewhere is not going to try and screw that up on a statement that they put out there, but generally that should work as a rule of thumb. Okay? Questions about any of that? So kind of straightforward. All right, so these are already after tax distributions, so I don't have to tax affect them. So copy these. They're both going to the shareholders. And that ends the TII. So if I did this right and I add these three together, the after-tax interest expense plus the minority interest plus the net income, I should get 247.8. But I didn't. Why not? What mistake did I intentionally make that you should uncover? Where did I mess up? Yes? Because minority interest is a distribution to the shareholder, so putting it as a negative 20 will cause your statements to not balance. Because remember, on this side of the statement, any distribution is a positive number. So I would have had to have flipped the sign, and then I have a balancing statement. Okay? And so across the 3 years, 247.8, if I did this right, 140.4 because I didn't copy the change sign. Actually, just copy the change sign. Be lazy. Okay. So again, common mistake that you can make, right? But very frustrating when it's late at night and you're trying to figure out why doesn't this damn statement balance, because you forgot to flip a sign, typically, or you forgot to put something on the statement that was on the original statement that you didn't convert over. Right? And then the third one is you try to put dividends on here, which dividends are not part of the income statement, and then it would never balance if you tried to throw the dividends on there. So this would have been the solution for your balancing TII. So now what we know about the company is we have how much profit they made from operating activities, how much profit they made from non-operating activities, what is the total profit of the firm for both, how is it distributed to the debt and the equity holders. That's the TII. Questions about TII? Hopefully most of you got this. All right, let's talk about statement number 2, TFI. This one should be technically even easier, but same concept. Take my years over equals 17, 18, 19, and label. And then we want to start putting all of the operating items first together. So we take any asset that is operating and I bring it over, all my ones. So down here, operating cash, receivables, inventory, current assets, PP&E, goodwill and intangibles. Those are all my ones. And then I look for my liability ones, accounts payable, there's 3 of them. What's next? Other current liabilities and other long-term operating liabilities. So copy. So I have, if I want to count, make sure I got 3 of my liabilities and 1, 2, 3, 4, 5, 6 assets. So I come over here and liabilities. 1, 2, 3, 4, 5, 6. Okay, so I've accounted for everything, picked all my Lego pieces up, and I've put them in. Now, when I do my operating invested capital, that's what we're going to call this, then I take all of my assets, operating cash plus receivables plus inventory plus other current assets plus PP&E plus goodwill, subtract out any liabilities, then I get my operating invested capital. Now, I got a question from somebody over the weekend, email. They said, can you look at the statement? It doesn't balance. My, numbers don't add up. What they were doing is they were adding in the liabilities. Okay? So just make sure that you net liabilities. So assets minus liabilities. This is also another reason why you can't use something like Investopedia. Because in Investopedia, they'll define, for example, working capital as current assets minus current liabilities. And we're clearly not using that definition when we consider things assets, because current asset would exclude, you can see on here, excess cash as an example, and current liability would exclude short-term debt. So we wouldn't come up with the same definition if you didn't read the book, didn't pay attention in class, and tried to use definitions outside of this class. Right? So you've got to definitely pay attention to the format of the statements and the framework that we are going through. Right? But nonetheless, this will be our operating invested capital. We will then add in our non-operating capital, which would be anything that's a 2. So if I look at the 2s, I have my excess cash, I have my equity investments, and I have my other long-term non-operating liabilities. So my non-operating capital, same thing. I net these together. Take these 3, copy them over. Those are my 3 2s. Assets plus together minus the liabilities. Net the liabilities out. 465, 935, and 715. Okay. Now just a couple more points. What is an equity investment? That is the stake that I have in another company that I don't control. From that other company's perspective, that is a minority interest. So the equity investment's the other side of the minority interest transaction. They'll be equal. My equity investment is somebody else's minority interest. My minority interest is somebody else's equity investment. Okay, not operating. Where does goodwill come from on the balance sheet? How does a company generate goodwill? Yeah.
Like any intangible assets, so patents, things that aren't like an actual product.
But how do they get generated in the balance sheet? So they are intangible assets, but how do they actually show up in the balance sheet? Yeah. You purchase them. Okay? So remember, anytime you see goodwill, that's a purchased intangible. And the most common way in M&A is you buy a company, you say, this company had this many assets. I usually pay more for the assets than what they had in their books. The difference between the two is goodwill. It just forces the balance sheet to balance, right? Because if I buy a company with $100 million of assets and I pay $300 million for it, how do I get the balance sheet to balance afterwards? I got to put the other $200 million somewhere. The difference between the purchase price and the assets I bought goodwill. Okay? Now, again, that's where it's coming from in the statement. But nonetheless, if I add my operating invested capital and non-operating capital together, I get my total funds invested, or TFI, the 3260 in operations, plus the 465 in non-operating capital, 3725. Copy that. And paste that over. All right, any questions about TFI? Now again, how is this financed? How do we finance the non-operating and operating capital together? It's all of our interest-bearing debt, anything that's a 3, doesn't matter whether it's current or long-term. In this case, our 3s on our balance sheet. Short-term debt, long-term debt, and that's it. Then I look for all my equity accounts, anything that's a 4. So my 4s would be minority interest, preferred stock, common stock, retained earnings, and treasury stock. So just to make it a little bit easier, copy and paste all the way down to treasury stock. So those are my 3s and my 4s. If I sum my 3s and my 4s, and I did it right, it should match the 3725, the 3702, and the 4090. Just out of curiosity, we talked about minority interest and where that comes from. What about treasury stock? Where does treasury stock come from? What is treasury stock? It's not a bunch of stock you found in a treasure stock on a deserted island that the pirates left. So I'll tell you it's not that. Yes?
The repurchase of common stock usually.
It's the repurchase of common stock. And you might say, gee, why is it put in this treasury stock account? Why don't we just reduce common equity? And the short version is because it's done at market prices. Treasury stock is the purchased amount at the market price. Common equity paid in capital is the common stock that's issued at book value or par value, right? And typically when you buy it back, you typically pay a premium. So you're going to buy it back at a higher rate than you originally sold it to the investors. Okay? So we put it in a separate account because you're buying it back. It's a negative. It's a distribution of equity, so it's reducing the equity in the firm, right? And that distribution of equity, basically, essentially, if you think about it, it means that the remaining shareholders have a bigger slice of a smaller pie. Okay? But those shares that the company buys are taken out of circulation. So the company cannot vote its treasury stock. Right? The stock is just eliminated. It's like it never existed. Right? It's held in treasury, but it's out of circulation. Right? So the remaining shareholders get a bigger piece of the pie and essentially more voting rights because they have fewer shares outstanding to vote with. Does that make sense, everybody? All right. So one other thing I want you to understand about treasury stock. First, there are some companies we'll probably run into this semester that have bought back so much stock at a high price that it was more than what they issued at a low price and will have no equity, or essentially negative equity, because they've actually wiped out their equity by buying back all their stock. Okay? Because that's the point. If I issue stock at $100 million and I buy it back at $1 billion, then I can quickly wipe out my equity. Right? So you can actually see companies with zero equity because they've been buying back a lot of shares. Right? And you also might wonder, why do companies buy back shares so often these days? Right? Even more so than they did 20 or 30 years ago. And part of the reason why share buybacks have become more popular is because of a change in the tax law in the United States. Historically, at one point, the tax rate on dividends and the tax rate on capital gains was the same. Okay? So it didn't matter whether you bought back the stock or paid a dividend, you paid the same tax rates. They changed the tax laws. So the tax rate on dividends is ordinary income tax rate, which could be 35% or so. And then the tax rate on capital gains, long-term capital gains, could be 10 or 15%. Well, it doesn't take a financial genius to say it is better for the company, and from a shareholder standpoint, to give them money that's going to be taxed at 10 to 15% versus money that's going to be taxed at 35%. So share buybacks have gotten more popular because they're better from a tax effective perspective to the investors, right? So number one, it lowers your taxes. The other reason why share buybacks have gotten more popular is because dividends, for whatever reason for public companies, have become sacrosanct. If you cut the dividend, it's like not making a debt payment. People go crazy over that, right? Even though dividends are supposed to be discretionary. So reducing the dividend has political consequences, not economic consequences. Where for some reason, if I buy back your stock and I don't keep buying back your stock, nobody goes upset. They don't go crazy over the shortfall of stopping a buyback. So from a company standpoint, share buybacks allow you to do a discretionary distribution, whereas dividends, even though it's discretionary, tend to be more long-term committed distributions. We don't want to cut the dividend. That's the point. I raise the dividend, I cut it next year, bad things happen to me. I buy back stock, I don't buy back stock next year, nobody seems to care that much about that. So the other reason why companies like share buybacks is that they don't seem to have the long-term commitment of a dividend, okay? I'm going to give you a third reason why companies like to buy back stocks. Bonuses for the senior management team, including the CEO, are typically tied to stock price appreciation and/or improving earnings per share. If you buy back your stock, you manipulate your share count because your share count goes down. Okay, net income stays the same, fewer shares, EPS goes up. I can magically increase share growth in earnings per share by buying back stock. Okay, as the income doesn't change, but it looks like my EPS is growing, and I am tied to my bonus on growing EPS. That's been happening with a lot of companies. And then the other thing is, if there's fewer shares outstanding, when I buy it back, people get a bigger share of a smaller pie. The share price of the remaining shareholders goes up, even though the value of the company hasn't changed because there's fewer shares outstanding. So the other reason why share buybacks have gotten popular is it makes the management look better because you're growing your EPS and it's boosting your stock price artificially, because the real value of the firm is not changing. Matter of fact, you're going to see that as we go through this Modigliani-Miller conversion, because the operating value of the firm, the free cash flow, does not change whether you do a dividend, a share buyback, or a payment to the debt holders. Any of those three distributions does not change that operating cash flow. Doesn't change the value of the firm. So that's the whole point. A dividend distribution, a stock buyback, it's just a distribution of cash to the shareholders at the end of the day from a value standpoint. There's political reasons why people do other things, but nonetheless, it doesn't change the value. That's something you're going to understand as part of this class as well. Okay? But back to this, treasury stock, those are the share repurchases. And it's netted. Netted against the equity because it's a distribution, and it's cumulative share repurchase to report in the balance sheet. So that is our balancing TFI. Questions about the TFI? Statement number 3, CFI. If I had to guess, this is probably the one that you had the most trouble with. Okay? So either one of two things happened. Either you finished it relatively quickly, or you gave up after several hours and said, I can never get this thing to balance. You're probably in one of those two camps. So let's talk about how we get our CFI to balance. So remember, when we create statement number 3, CFI, the concept of cash flow is cash generated from the income statement. Okay? It's adding to my cash flow, minus cash invested in the balance sheet, which takes away from my cash flow. That's the whole concept of free cash flow. Gross cash flow minus gross investment. But the idea is cash generated from the income statement is pretty straightforward. Cash reinvested in the balance sheet involves, it's a balance sheet static statement, involves a change. So it's the change in cash from the income statement minus the change in the balance sheet. That's kind of conceptually what's going on in the actual statements. So that's the process. We're going to repeat 4 times. Okay? So starting out with the operating cash flows for the 3 years for CFI equals these 3 years, the label. I want to start out by taking my cash from the income statement, which for my TII is my no plat, except buried in no plat is a non-cash item called depreciation. So to get what's called my gross cash flow, which is the cash flow from the income statement, I take my no plat and I add back my depreciation. And that is what's going to get me to what we're going to call gross cash flow, or the cash for the income statement. So in 2017, depreciation was listed here as minus 240. So first thing is, if it's no plat plus depreciation, if I subtract that negative depreciation, it's going to lower my income. So again, have to think through the signs here. That doesn't make sense. So I'm going to have to flip the sign on that one to a positive. And no plat plus depreciation says my gross investment, or sorry, gross cash flow is 457. That's how much cash I generated from the income statement. Now, here's another thing. Typically, you won't see depreciation on an income statement. Accounts don't break it out. You'll have to get it from the statement of cash flow, right? Because most of the time, depreciation comes from PP&E, okay? And PP&E is buried in cost of goods sold. It's a direct expense. So the accountants will put depreciation in cost of goods sold, but they won't break out and say, here's the cost of goods sold or direct expense that's cash, and here's the non-cash. They just call it cost of goods sold, right? So when you look for depreciation in the real world, you're probably going to have to go find it on the GAAP cash flow statement. That's where you're likely to see the depreciation. You're not going to see it broken out in the income statement. I'm making your lives easy by putting it on an income statement, but that is not common, okay? I will do that for these assignments, but once we go to the real world, we'll look this way. Just letting everybody know. All right? So that's our gross cash flow. All right. Now, next, we have to do our gross investment to get us to free cash flow. So our gross investment and I gave you a shortcut for this, equals current year invested capital minus previous year's invested capital plus current year depreciation is gross investment. Okay? That was the shortcut I gave you for gross investment, negative 273 and 868. Okay? And if we subtract that gross investment from the gross cash flow, we get our free cash flow, our operating free cash flow. Okay? However, I'm going to show you the granularity behind the shortcut. Okay? And so I want to go back to the balance sheet. So this is probably what you did in your homework assignment, and this is acceptable. But what I'm about to do is I'm going to rearrange this balance sheet. Okay? And what I'm going to rearrange this balance sheet is into working capital and long-term capital. Okay? So what I'm going to do is I'm going to take anything that's current, so I'm going to insert mouse to work. Why is my mouse left click working? Insert. Rows. There we go. I'm going to take my current assets here, And I'm going to take my current liabilities, which are here, the accounts payable and the other current liabilities. Cut. Paste. And I'm going to net my current assets against my current liabilities to get something called operating working capital. As opposed to what accounts call working capital, which is all current liabilities minus all current assets. We're not doing that, we're just doing the ones. Okay? So when I do that, I'm going to get an operating working capital of the operating cash plus the receivables plus the inventory plus the other current assets minus the liabilities, the payables, and the other current liabilities. And that's going to get me working capital of 810, 767, and 725. Okay? And to that, I am going to add my long-term capital together, which is my long-term assets of the PPD, goodwill, and intangibles, and other long-term liabilities. Now my mouse is working. That's really good. To my, I'll put this down here, my long-term capital, which is the PP&E plus the goodwill minus the liabilities, so that when I add this up, 810 plus 2450, I still get the same 3260 and the 3725 TFI. Okay. So I get the same numbers, but I'm just adding up my short-term and long-term capital as opposed to lumping everything together. Okay? Rearranged everything. I'm going to say, gee, why is he doing this? Why is he making my life more complicated? The answer is because when we get to Section 3 and we get to valuation and we start forecasting the companies, the rate of which inventory grows is probably going to be different than the rate of which a plant grows. Right? Companies may not build plant every year, but they're building inventory all the time. So the growth in each of those will not go up at the same rate. So translation, we could forecast an average growth in all of the assets, but we will get a better valuation if we forecast the rate of growth of working capital differently than the rate of growth of the long-term capital. Okay? Now, that's the point. It's the same reason why we're doing operating and non-operating ROIC versus average ROIC, because it gets us better insight. This gets us a better valuation. So that's why I'm rearranging this. And so going forward, this is more of the format you will see of the rearranged statements. Okay? Breaking it out so that we can forecast them to go up at different rates instead of lumping them together. Now, for your purposes of your assignment, you can still lump them together to get the overall operating invested capital, but this is why I'm rearranging it here. Questions? Make sense? Not make sense. All right, so let's go back to our CFI. So the shortcut CFI was the gross investment. Let me show you with the long way of doing this how we're going to get to the same number. Okay? So what is gross investment? Well, the first part is it's going to be the change in the balance sheet. So it's going to be the change in the working capital. Okay? So my working capital equals TFI went from 810 to 767. It went down. I have less working capital, right? So if I'm adding them up to show my gross investment, a minus working capital reduces my gross investment, okay? So that's my change in working capital. Went down by 43, and then it went down by another 42. So in a way, I am disinvesting in my firm and therefore lowering my gross investment. If you're thinking about the sign. So I don't have to change that sign. Okay. Next, it's the change in PP&E, the change in goodwill, and the change in other long-term liabilities, or my change in long-term capital. But for this one, I'm going to write it out. Change in PPE, change in goodwill, change in long-term liabilities that are operating. Now, here's the point. The reason I'm writing this out, so I want you to think about this for a second. If I buy another company, I buy goodwill, my goodwill goes up, I know that the actual amount the goodwill went up was the purchase price premium I paid. So I know that's a cash flow. If I pay off a liability, I know the reduction of that liability reduces my cash flow. I know I paid that amount out. Change in PP&E is a little different, okay? Because going from one PP&E to another PP&E is not just the change in PP&E in the cash flow. As a matter of fact, I'm going to write the formula over here on the right. The formula is if I take my starting PP&E balance and I add in my what's called capital expenditures, which is the new property, plant, and equipment that I'm buying during the period, I then subtract the depreciation, which is the amount of value my assets are losing during the period. That will get me to my ending PP&E balance. Okay? So the point is, the amount of money I'm spending to buy new property, plant, and equipment is called capital expenditures, or CapEx. So what I want on my cash flow statement is not the change in PP&E, but what I want is the capital expenditures. That's the cash flow. Okay? So just like it's not net income, it's the dividend, it's the CapEx, not the change in PP&E. So that's the point, right? So here's the idea. I need CapEx. One, I could go to the GAAP cash flow statement and look up the cash flow, and I didn't give you one. Or two, I can solve for CapEx. Because if I rearrange this equation, I know that capital expenditures must be the ending PP&E balance minus the starting PP&E balance plus the depreciation. That's just rearranged math. Makes the formula work. So I can solve for CapEx using that equation. By the way, the plus depreciation in that equation is why in the shortcut it's change in assets plus depreciation, because it comes from the CapEx. Okay? That's actually where the plus depreciation comes from in the shortcut. Because when you net everything together, everything is the change except the plus depreciation. Okay? So back to, what is my CapEx? My CapEx is, for TFI, my ending PP&E minus my starting PP&E plus current year's depreciation. I know my CapEx had to be 20 and 660. That's what I'm investing in capital expenditures. Questions about that? Okay. Then goodwill change equals, I went from 250 to 300. I increased it by 50. That's a gross investment. My long-term liabilities went from 200 to 500. They went up by 300. If I'm not actually spending the money for something, then that's actually not an investment. So an increase, if I'm going to add these together, so either add the two and subtract this to get to gross investment, or if I'm just adding them all together, I would have to flip the sign. So my gross investment equals this plus this plus this so in this year, these are all ones, I basically disinvested so that my free cash flow, plus change of working capital. Forget that one. $273 and $868. Okay, so shortcut, granularity, same answer. Okay, so when I get to my free cash flow, equals the gross cash flow minus the gross investment. I generate 654 because I had disinvestment and negative 475. Okay. Now I go to the financing side, or sorry, non-operating. Non-operating cash flow, two ways to do it. Here's the shorter cut. I could either write them out or go to my income statement. I got two twos. The non-operating items right here, interest income and non-operating income after tax, or I could just take my non-operating profit line. So it's my non-operating profit, which is the cash from the income statement, plus or minus the investment in the balance sheet. So again, two ways I could do this, but I have off my balance sheet non-operating capital. So my change and my non-operating capital equals, for my TFI, it went from 465 to 935. Right? So if I'm thinking about my cash flow available to investors, I know that if I generate free cash flow, that's cash that I can pay out. It's a positive to my CFI. I know that if I make profit from the income statement from a non-operating activity, that's cash that I could pay out. It adds to my CFI. If I increase my assets by 470, I am spending 470 more in cash on non-operating capital. That's going to reduce my CFI. So if I'm just going to add these together, I would flip the sign so that my CFI is the 654 plus the 29.4 minus the 470, 213.4 for CFI and negative 227. Questions about any of that? I know the other side of my CFI is the distribution. So how did I distribute the 213.4? How did I fund the negative 227? Debt and equity. Again, from the income statement, equals the after-tax TII. It's going to be my after-tax interest income. That's my threes. After-tax interest expense. That's my threes. And then it's going to be the change in the debt. Now again, you could have added both debts together, but in this case, I'll do change in short-term debt, change in long-term debt, or my change in my debt. So my debt went from TFI 80 to 240. So again, if I'm increasing my debt, that's cash coming into the firm. So that's not going to be a positive 160. It's going to be a negative 160. So I need to flip the sign. Change in long-term debt, same concept. equals current year minus previous year. If I increase that debt, it's going to be a negative, so I'm going to have to flip that sign. So that negative 400 should represent an increase in the debt. So I've increased my debt. Okay? If I pay off the debt, it should be a positive number on my CFI. That represents the positive payout, paying off the debt. Okay? Next, when I get to the equity, it's not net income. That's not the cash distribution to shareholders. It's the dividends. Now, in this case, I have two types of dividends. I have common and preferred. Those are my equity cash flows, and those are positive numbers to the shareholders. All right? Then I have change in equity. For my equity accounts, off of TFI, starting with minority interest, going down to treasury stock. But the problem is I'm doing change, and retained earnings is not going to be a cash flow, a change in retained earnings. So even though it's on my TFI, I delete it from my CFI because I don't want to have a change. All of these are change. Okay? So minority interest equals, there isn't really a change, but if there were, I would flip the sign. Okay, same thing with preferred stock. If I increase my preferred stock, that would be a flip sign. In fact, I can quickly see this. That's the negative 100 of extra preferred stock that I've done. Common stock, same thing. If I issue shares of stock, which I didn't, current minus previous. And treasury stock equals here minus here. Now, if it goes from negative to more negative, treasury stock, that means I'm buying back more treasury stock, which is a cash outflow. So on this side of the statement, I flip the sign on these as well. So all these are going to be flip signs. Let me flip this sign just for the solution. So if I did everything right, which we're about to find out, and I sum all these up, I should get the 213.4 and the 227. Where did I mess up? Yep.
I think you have to add the minority interest as well, like not just the change.
So the minority interest,
Yeah, not just the change, but also like the minority interest in TII.
oh yeah, isn't there an extra 4 on the income statement? Minority interest? And did I put that in there with the dividends? See? This is number 1, why we want to balance. And number 2, why it'll help you when you can't find out why you balance. You go back and you say, aha, there's an extra 4 on that statement, and I add up all my 4s, I'm missing a 4. Okay? So that was the point. If I'm missing minority interest on the income statement, then equals TII, where is it, right here, minority interest, which is the distribution. So this is that minority interest. And I add that in, and voila, it balances. All right? I'm just telling you, for those of you that gave up after hours, this is how you struggle, right? Because you probably either forgot to do something, like I just made that mistake there, or you had trouble with the signs. of the things that you did put on there. Or you left retained earnings on there, or you threw net income on there, or something like that, and then the statement's never going to balance. But this is CFI. Questions about that? All right, as quickly as I can, statement number 4, economic profit. 2 methods. The first one, usually the spread method. To do the spread method, I need an ROIC. What is my ROIC? It's going to be my NOPLAT divided by my TFI. Invested capital gets me my ROIC. Okay? And I need to do that for the years. Now, I'm asking you on the assignment for a beginning of year ROIC. So if I ask you for a BOY ROIC, it's current year NOPLAT divided by last year's invested capital, starting invested capital. So in this case, 49%. Or sorry, 4.9%, about 5%. Now, I'll then give you a WACC. On the assumptions, I said to use a WACC of 6%. So we get a spread between the ROIC and the WACC equals ROIC minus WACC, which is negative. So I'm destroying value. How much value am I destroying? I take the 1.1% negative. I multiply by the operating invested capital beginning of the year. I'm destroying $34.6 million worth of value in the year. Just to validate that, I take my NOPLAT and I subtract out what's called the capital charge. What is my capital charge? Well, my NOPLAT for the 3 years is here. My capital charge says at last year's invested capital times this year's WACC, I need to earn $95.6 million to pay them back at 6%. On my starting capital, I made 161. My economic profit is the 161 minus the 195.6 or 34.6. I now have balancing statements. Copy, paste. Copy, paste. All right, so that should have been your solution for economic profit. I will post this file. I will post this video if anybody wants to check it, but you kind of know how your homework's going to be graded based on this solution. All right, Wednesday, as I said, we're going to get into the analysis of these statements. Talk about CFI analysis and ROIC analysis. Okay, see everybody on Wednesday. Have a good day.